Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 19th of October. I'm Daniel Lam, your host for the podcast. Being head of equity strategy of the wealth management CIO team at the bank, you may assume that my favorite asset class is equities. Well, in fact, I've always been a strong believer in FX because the underlying drivers of Forex often serve as a bridge across different asset classes. Now, within FX, the most important currency on a global basis must be the king dollar. Now, the US dollar has been very strong over the last 3 years, with DXY, i.e. the US dollar index, going from 96 to nearly 115. And now it is still at a level of strength, going up by more than 5% since the summer. Now this strength is not surprising, because the US dollar usually performs well when there is a bleak global growth picture. And most of the new export PMI orders are now below 50. And the US new export PMI number has been outperforming many other markets. So the US dollar is actually acting as a safe haven across the currencies. Moreover, stronger growth has helped the US to maintain much higher positive real rates versus the rest of the G10 currencies. Despite its higher interest rates, the US economy is still very resilient versus other G10 nations. Case in point being the recently strong non-farm payroll, as well as the retail sales figures. US company earnings are also doing well in common currency terms, and stronger earnings revisions is helping net foreign purchases on US equities, and therefore leading to dollar strength. However, there could be factors that may lead to a mild pullback in the US dollar. For example, a temporary rebound in global growth led by China. Now, China reported an encouraging set of data yesterday, with beats in key figures such as GDP growth and retail sales. This could lead to potential interest in assets in the rest of the world versus the US. A reasonable technical indicator is the copper to gold ratio. Now that is showing some signs of bottoming, and historically is consistent with US dollar going weaker. Now, from a chart perspective, the DXY hit the top at 107 in the rally since July this year. And there seems to be some early signs of a head and shoulders formation coming. Now, if this formation does take shape further, the DXY index may fall to support levels such as 104.7, followed by 102.9. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.